Understanding Auditing Fraudulent Cash Discount. This is Ken Boyd, with the owner of St. Louis Test Preparation. Here is our email and our phone number. You'll see our website and our web channel at the end of this presentation. This is our 5th class in auditing. This has to do with a fraudulent discount. This is based on a true story that happened in St. Louis within the past 2 years. This is a direct quote from a newspaper article. An office secretary for a doctor, quote, admitted she sold more than $127,000 by telling patients they could get a 10% discount for cash and then pocketing the payments. How was the theft found? The doctor said that the payments I was able to review showed approximately $127,000 that could not be accounted for in my bank statements. So it was the bank statements review that caught this fraud. It gets worse. The ex-secretary also took patient records and deleted files from the office computer, requiring substantial time and effort to reconstruct, according to the doctor. So not only was there theft, but there was also damage of records. Here was the process that was in place at the office. The office secretary offers the patient a discount if they pay cash, which the doctor is not aware of. Assume that the payments were for co-payments and out-of-pocket expenses not covered by insurance. We've all gone to the doctor and paid those co-pays of maybe $20 or so. Receipt. The patient is given a receipt for the cash, but the secretary doesn't record that cash receipt in the accounting records. No paperwork is kept for the payment. So far the doctor is unaware. Continuing on with the process. Remember that the patient's in the doctor's office and the doctor has to do something. The doctor has the appointment with the patient. In addition to incurring the expense of his own time, he uses medical supplies like bandages, gauze. He also incurs the cost of using equipment like his x-rays and his computers. So there are expenses incurred when this patient is in the office. There's a service delivered, a product delivered. Bank deposit. The office secretary deposits the cash payments and checks every other day. She gives the receipts for the deposits to the doctor so the doctor can follow up on them later in his bank statement. And then at the very end, the doctor performs his bank reconciliation. He reconciles the bank account but tends to fall behind. Often the bank account is not reconciled for over a month. Very common among business owners. They're trying to run a business and they leave the accounting for later. So at some point, the doctor is going to go out and look at some financial records. He's going to review the financials for his practice. Maybe it's monthly, maybe it's quarterly. Maybe it's when something starts to look out of line. The doctor has records of his expenses. He knows how much time he spent with each patient. He has receipts for expenses that he's incurred for equipment, office supplies. So the expense side he's got nailed down. The problem is with the revenue. The doctor is not able to match expenses from each office visit with the revenue collected by the secretary. How much revenue could be missing? Well, let's assume a doctor performs 100 office visits during the 3rd week of March, maybe 20 a day for 5 days. The doctor calculates that 75 patients should have paid a $20 copayment. We've all done that. The other 25 patients should have paid a total of $3,000 in out-of-pocket expenses, things that aren't covered by insurance that they have to pay for. So that total revenue from clients before any payments from the insurance company that would come separately should be $4,500 for the week. We'd expect $45,000 coming in the door in the form of deposits, and our document would be deposit receipts. But when the doctor checks the total deposit slips for the week, he sees the deposits were far less than what he expected in his expected revenue. So how do we prevent this? We've talked about this in a prior video, segregation of duties, which is another way of saying divided responsibility. These three tasks should be performed by different people where possible. Now, we all understand that there's businesses that are too small and have too few employees to split up these responsibilities. First of all, physical custody of the assets. The checkbook, the vehicle keys, the keys to the office, any fixed asset that the business owns. Authorization for transactions. The larger the check, the more people and the more senior people in the business have to approve payment by looking at purchase orders and invoices, things that we've talked about in a prior video. And finally, recording transactions. In a small business, very rarely should a business owner give responsibility for reconciling the bank statement to somebody else, because the bank statement is where all the activity is reflected and it's where fraud can be uncovered. So unless the business gets pretty large, that owner should hang on to that responsibility. In each case, a separate individual should compare the expected revenue from each office visit with the bank deposits. That procedure would have prevented this sort of theft. That's the end of part 5. You'll find the next part 6, and other videos on YouTube. You can subscribe to my channel, Ken Boyd STL. For live tutoring and live chat sessions, including upcoming sessions on these accounting topics, www.stltest.net is our site. Here's our email and our phone number. We'll see you next time.